Hi there. fuboTV, as you can see, its performance isn't that great. Year to date, the stock price is down over 50%. It was almost $3 at the beginning of this year, but now it's about $1.4, and this is quite bad. The market cap is about 441 million, and if you look at past performance, you can see that revenue is over 1 billion, 1.3 billion, as you can see here for 2023, last year. So when you compare the revenue of over 1.3 billion to its market cap of over 400 million, you might say that this is a bargain. You might have some opportunities, but you also have to be aware of the risk, because if you look at the whole picture, you can see that this stock is down over 100%. Of course, this company was rebuilt in the past. The name has been changed and they have a new strategy. But as you probably know, the story started in 2020 when the stock price was about $10. Then because of the pandemic, the stock price went to the roof to $46, and then the stock price has declined by over 97%, and this is quite bad. So you might say that you want to take advantage of this company if you believe in its future, as the revenue keeps growing year by year from 2020 to 2023. As you can see, the revenue went from 200 million to over 1.3 billion, and their earnings, as you can see, have decreased. Their losses have decreased, and this is a good sign. As long as the revenue keeps growing and their losses decrease, they might become profitable, then Fubo will do well in the future, the stock price. Now, how come the revenue went up, their losses have decreased, but still the stock price keeps going down? As you can see, year to date, a decline over 50%. And the market cap is around 400 million. Why is that? Well, let's look at their balance sheet. You can see that most of their money are coming from subscription. As you probably know, this company, Fubo, has over 1.5 million paid subscribers. This is good. They have some users that are paying their subscription. Plus, they also make some money from advertising. A small amount, but it keeps growing. As you can see here, 27 million in the first quarter of 2024. So far, everything looks great. Revenue keeps growing, and so their subscribers, as you can see here, up 18% year over year compared to 2023. That's great. But now let's see more. Let's look at their balance sheet. As you can see, their total assets are over 1.1 billion. Keep in mind this number, 1.1 billion. And the market cap is only 441 million. So a big difference. And total liabilities are 900 million. Now, what's important is to focus on the right assets and the right liabilities. Of course, all the liabilities have to be paid, but the assets may not reflect the real value. So you have to focus on the right thing, especially on the cash on hand, which is over 168 million. This is the most important, the cash they have. Forget about the rest of their assets. Focus on the cash. So they have over 168 million in cash. And when you compare that amount to their total liabilities, over 900 million, and especially look at their debt, here, convertible notes, over 379 million, you see that their assets aren't that great. They have a lot of debt and a small amount of cash. Plus, as they have no earnings, only losses, this is a problem for Fubo. Because, as you can see, their cash position is going down. From 245 million last year, 2023, to 168 million. So they are burning out of money because, as you see here, net loss is over 56 million per quarter. And that's why they are burning that money. They need more money to fund their operations because they have no profits. When they become profitable, maybe this amount will increase, will go up from 168 million back to 200 or even more. But so far you have to be aware that they are burning out of money and this cash position will decrease in the future, next quarter and next years. And this debt may increase even more. So you have to be careful about this company. Their balance sheet is not that great. They have a lot of debt, just a little bit of cash, and this is a big risk for Fubo. Even though the revenue is going up, and so their number of subscribers, this is the good side of the story, but you also have to be aware of the risk, because if they don't manage to become profitable soon, then they might face problems. They have to take on more debt with higher interest rates, and if they don't become profitable in the next years, they might go bankrupt. That's the risk. Plus, another problem with this company is this huge decline in the stock price. Why that happened? Over 80%. Why is that? Because you saw the revenue went up and so their losses have decreased. But when you look at the number of shares, you can see that at the beginning of 2020, they had about 30 million, 28.9 million shares outstanding. But this number has increased a lot, from almost 30 million to almost 300 million. So you have a 10x in the number of shares. And this is quite bad. That's why the stock price have declined so much. From 2020, at the beginning of 2020, as you can see here, to today, a decline over 85%. When the number of shares increases so much, so your investment decreases over time, over the next 4 to 5 years. And if they continue to issue more shares, the stock price will continue to go down even more. If you look at the last quarter, here for 2024, you can easily see the number of shares here compared to the last year, 2023. It has increased from 225 million to almost 300 million. And this is bad, quite bad. Because the more shares they issue, the less valuable your stock becomes. It's obvious, you have to divide your pie with more shareholders. The more there are, the less you get. And you don't want that. You want a decrease in the number of shares. If that happens, and Fubo becomes profitable, they might turn this loss of 287 million in profit, then for sure the stock price will rebound back to $30 or even more than that. That can also happen as the market cap is so small, of about 400 million. Maybe you remember my past videos when the market cap was about 2 billion and I said that the stock price will continue to go down because of dilution, this huge dilution. It was easy to predict. Moreover, there is another problem, which is competition. There is a joint venture between Disney, Fox, Warner Brothers, Discovery, that want to combine their sports assets into one single joint venture, a streaming company that will compete with Fubo. And this is quite bad because, they have a small number of subscribers, 1.5 million. But if more users want to move to the new platform, the new streaming platform, then Fubo will lose a lot. Of course, as they are so small, they have only 1.5 million subscribers. Also, their market is huge. They can grow a lot, from 1.5 million to 10 million. That can also happen if they have the right assets. But as you probably know, they don't own those assets. The rights are owned by those major companies such as Disney, Fox, and Warner. And this is quite a problem, because in the long term, their platform will be affected. And who will want to pay their subscription when they can find better content on the other platforms, on the new venture? You have to think about that. That's why, as I said in the past, there is high competition in this industry, the streaming industry, especially for sports. You don't want to compete with Disney, Fox, Warner, and other companies, especially with a company that doesn't have any profits, as you can see here, only losses, and a weak balance sheet, a lot of debt, and just a few assets. You don't want that. You don't want to go to war with a company that doesn't own anything, no rights. And if you have other questions, please let me know in the comments.